Welcome to the Daily Stock Review. We're going to go over Apple today. Goal of this channel is to find the world's best stocks that have 100x potential. I'm an individual investor on the journey, just 2,500 hours in over the last 7 years, and I'm sharing the lessons along the way. Today we're just going to go straight into Apple's stock analysis. This is my investing process. I'll give you a heads up where I look for these opportunities and came across Apple, and then the 5-minute check that we'll be completing today to make sure if it's worth looking into further. Learn from these guys, following the breadcrumbs that they've left behind, so hopefully we can follow in their footsteps. Let's jump straight into it. So all I'm looking for is Apple's annual report. So as I navigate through that and find the latest, I'll give you a heads up where I came across it. So I used to have way old flip phones back in the day and had a complete distaste for anything Apple. That started to change after I got a iPod. Yeah, iPod back in the day, and then I started to really enjoy the interface and things like that. So then over time, I ended up getting an iPhone back in, I think it might have been 2015 or 2016. And then I've been a convert ever since. From that time, looking into and around Apple, it has obviously, everyone has pretty much got an iPhone at this stage. There obviously is competitors like Android, but they haven't just gone into phones. They've got a lot of other revenue streams and things like that. So that's how I came across it in everyday life, was, I guess, my interaction with Apple, and loved the product. If there's things like that you guys see, that is definitely one way to find great businesses to first look at and see if they're worth investing in. All right, so now they've got the annual report, just the latest one, which is last year in 2025. What I am looking for is the financial statements, and so I just want to have a look through these. This is what we're going to do for our check. Want to look for three things. I want to see if the business has mastered its customer. So are they making some pretty good money? Do they have some growth that's still occurring? And do they have some pretty good margins at the end of the day? So after they've, a customer buys their products, how much money does the business actually keep at the end of the day? Now, I also want to see, do they have a moat around the business? And you can see that in the financials. There's no point thinking about lots of talk about a business, or the management team talking about how good their business is and all the cool innovations they're doing. You actually want to see the results in the financials, and that's a way that we can actually tell the business has really good product market fit and it's beating competitors. And the next one is management. So when we get to the cash flow statement, we'll be able to tell, is management being rational with how they're spending the company's money? Because long term, if there's a terrible management team with a really good product, they'll destroy the business. But if there's a really good product or it's kind of mediocre and they have a pretty awesome management team, they'll be able to turn that around, improve the product over time, and then have an amazing product. So, and a healthy company that shareholders want to invest in. So what do we got? Here's our statement of operations, which is also known as the income statement and also known as the profit and loss statement. So we want to have a look. So we got net sales for products and then for services. So from 2023 to 2024 to 2025. So the products hasn't really grown. It stayed pretty flat. It's grown a teeny bit. And then services has grown from 85 to 96 to 109. And these are in millions. So that means millions and billions. So 85 billion, 96 billion, 109 billion. So the services arm of the business is growing. Now, overall, net sales has grown as a result of that. Cost of sales, let's just have a look at what the gross margin is. So we've got 169 billion, 180 billion, and 195 billion. So we can see here that, what do we got? It's costing, the cost of the services has stayed very flat, but the amount of money that they get from those services has grown a lot more. So what that means is if they continue to pump and like promote these services and things like that, that is a very high margin. So it's like they are only spending 25% pretty much on those services. Whereas for the actual products, they've got to spend about 60 to 65% to be able to pay for those products. So they're only keeping about 30% versus the 75% of cash that they keep for the cost of those services. So they're growing in a very profitable part of their business, which is really good to see. What about operating expenses? So they got research and development, selling, general, and admin. See, selling, general, and admin and research and development is grown a bit, but not a crazy amount. Operating income, cools, and net income. So net income, this is the bottom line of the business. They've gone from 97 down to 93 and then up to 112 billion. So it's good to see that it's, I guess, the business is still growing. Let's have a look at the balance sheet and just make sure that the business is healthy, and it also fleshes out any things we want to have a look at in the cash flow statement. So it started off at cash equivalents, marketable securities. All right, so our total assets are there, definitely less than our total liabilities. They've got non-current debt and term debt. So let's have a look. So term debt of 85, it's gone down to 78 billion. Other current liabilities, smaller than that. And what do we got here? We've got some total current liabilities. So things that need to be paid in the next 12 months versus their total current assets. So usually we'd like to see total current assets to be more than current liabilities. So it's just a little bit of a yellow flag to keep an eye on. A lot of that looks like it's in accounts payable and other current liabilities. So things like manufacturing all these products, they need to be able to pay their suppliers for those bits and pieces. And so at the time and snapshot in time of this balance sheet, that's how much they still had where they'd been either provided those services or they had commitments to be able to pay those as well. All right, so balance sheet wise, they've got a lot of cash in hand. They're making a lot of money. So at this stage, unless the business goes significantly backwards, would the debt within the business start to look a bit iffy. By this stage, it's not really a concern. Could be healthier. Now we want to have a look at the cash flow statement. And what this does for us is it helps us understand where the money is actually being spent within the business. The income statement tries to balance that all out. But what we're doing now is we've got our net income from that income statement. It then gets adjusted. So we take out all these non-cash charges, things that haven't actually been paid for yet, but they're just kind of like write-offs and things like that where they need to allocate that money for years to come. Changes in operating assets and liabilities, all fairly minor. There's a couple of bumps around here where it just means there's a bit of variance between the years. And so other current and non-current liabilities, we get this cash generated from operating activities. So you can see that that's been pretty consistent. Now what we want to do is we want to grab anything that the business needs to continue to invest in, like in terms of its assets, that is going to affect its growth into the future or maintain its current position. So that's usually property, plant, equipment. We subtract that from it, and we end up with, well, it's pretty much 100 $100 billion of free cash flow. And it looks like that's remained very consistent over the years. Like I said, a little bit bumpy with a couple of larger one-off kind of events, but that's why we bother and spend the time to look through these, just to see what the general trend is and how much money we're talking about. So everything after that point is what the business then gets to decide to invest within the business. So payments for taxes, different things like that, repurchases of common stock. So you can see here that a large amount of that $100 billion is getting plowed into Apple repurchasing its own stock. Now, why would the business do that? It's a long-term value add to the business. So if the business has extra money and it has nowhere else really for it to invest for that growth, by repurchasing its own shares, it can then make the long-term shareholders, makes each one of their pieces of a share that little bit bigger. And so over time that increases its value. Now, the business needs to be clever about that. It needs to be purchasing its own shares when they believe it's below or at its intrinsic value. If it's overpaying for that, then it's going to destroy value over time. All right. So from there, repayments of debt and things like that, cool. It's just keeping the status quo for a lot of other things. But its main objective here is to repurchase its own common stock. All right. And that is more of a, I guess, I look at it more fondly than just providing dividends, because it keeps that within the business. Shareholders and things like that then don't have an event where they need to then go and pay taxes on that and lose the growth over the long term. So there are advantages of that. All right, so my overall summary. Mastery, yep, Apple's definitely mastered its customer. iPhones and things like that aren't receding. They're continuing to stay at the, I guess, leading edge of what customers are after. What else we got? The moat within the business, it does have strong profit margins that are coming through the business. So with those gross margins at the end of the day, and with the services arm that is growing faster than the products, and with that very high margin that it's got, so keeping 75% of the money that it gets from them. What else have we got? And management. So is management being rational with how it's spending its cash? I'd say yes. It's making effectively $100 billion in free cash flow, and then plowing the majority of that, 90% of it, straight back into repurchasing its own shares. Now let's have a look at what the Apple stock price has been doing. So over this time, if we go back even another 5 or 10 years, this graph looks the same. It's just that over time it continues to grow and grow. So over these years, we can see that there's definitely been some opportunities where, I guess, the stock price hasn't been perfectly flat in terms of its increase up to where it is today, growing perfectly with what the value of the business would actually be. And so there's been definitely some opportunities in here where the business could have repurchased a lot of stock at a better price than it could have. All right. If you like these teardowns, feel free to subscribe so you don't miss any ones that are coming up. Is Apple a business that I think will 100x again compared to what it has already? That's probably the question. I'd probably say no. I'd say this is one of those more mature companies that will continue to grow. And so having a look further at it and doing a bit more of a deep dive would be beneficial, but it's not going to be a business that's going to continue to grow at the rates that we've seen in the last 20 years. So have we missed the boat? Yeah, probably missed it in terms of jumping on at an earlier time when this business would have grown at the huge rates that it had when it went through a large boom. But there's definitely an opportunity for it in terms of being a bit more of an anchor of your investments. So feel free to have a look into that a bit further and do a deep dive of your own. If you have any questions, comments, feedback, feel free to put it in the comments below. I'll be reviewing those in upcoming videos. And otherwise, check out this next video because YouTube reckons you'll like it. Cheers.